Welcome to the Deep Dive, where we cut through the noise to get to the heart of what's truly driving company performance. Today, we're plunging into the Q2 FY25 results for Note AB, that's Note B on the ticker. They're a Nordic electronics manufacturing services provider, focusing on industrial and defense clients. These numbers just hit the market pre-open today, July 14th, 2025. Now, this company, they've navigated some, choppy waters recently, so the big question we're tackling is, are these latest results just a temporary calm, or do they signal something more fundamental, a real shift maybe in Note B's strategic direction and, long-term potential for you as a listener trying to understand this space?
Exactly. We're here to give you those critical insights. We'll go from the headline numbers right down to the strategic nuances that really matter for understanding where this company is headed. You get the full picture of the core story without needing to wade through, hours of transcripts yourself.
Okay, so let's jump straight in. The numbers. Because Note B, they delivered a pretty impressive earnings surprise, beat on both the top and bottom lines. Revenue came in strong at 980 million Swedish krona, SEK that is, comfortably beating the 964 million SEK consensus.
Yeah, solid beat there. And on profitability, their diluted EPS, that's earnings per share, hit 2.65 SEK. That nicely topped the street view of 2.30 SEK.
Oh, right.
And what's maybe even more telling is the underlying operating margin. That's a key measure, right, of their core profitability. It widened by 50 basis points, 0.5% year over year.
And that points to your...
Well, it's not just one thing. It's a direct reflection of good cost discipline, smart management, and also an optimized product mix. This upside, maybe modest on its own, but was broad-based across their operations. And the market, it clearly reacted positively today.
Okay, let's unpack this a bit more, though. The CEO noted Q2 came in largely as expected, which is quite a statement, especially considering their earlier caution back in Q1 about, global factors, market turbulence. Makes you wonder, what changed? Or what were they seeing that made Q2 suddenly as expected?
That's a really good point. And yeah, while Q1 reported that 10% margin and Q2 came in slightly lower at 9.6%, management actually clarified this. They said these are very similar quarters, fundamentally.
Okay.
Some of that difference is just movement due to work in progress.
Yeah.
Stuff being built in Q1, getting finished and sold in Q2.
Okay, so timing, basically.
Exactly. So that slight dip, it isn't really a red flag.
Yeah.
And overall, earnings per share saw a healthy 7% increase year over year, which is pretty solid in this market, you have to say.
Right. Okay, shifting gears then. Let's talk capital. Cash flow. Always good news when it's strong. But for a company like Note B in this market, what does strong really mean in practice? Are they just building a cushion, or is this cash maybe a strategic asset, something poised for, something bigger?
Yeah, and that's where it gets really interesting. Their operational cash flow just for the year to date reached an impressive 260 million SEK.
Wow.
And that's 214 million SEK even after investments.
Okay.
Now get this. This figure is significantly higher than the quite substantial dividend they paid out earlier.
Yeah.
Their net debt, very manageable, 117 million SEK. And their cash position is robust, really robust, 634 million SEK. That's actually the second best cash position in the company's history.
Second best, okay.
And they explicitly stated, quote, they earned back the dividend with margin in the first 2 quarters.
So they're not just treading water.
Not at all. This isn't just a cushion. It provides significant strategic room to maneuver, whether that's for internal growth or, external opportunities. M&A, perhaps.
We'll get to M&A later, I bet. But it's interesting hearing management sound so optimistic about future growth, especially given, as you said, sales have been kind of flat, maybe even down over the past year or so. Is this just wishful thinking, or is there something concrete backing up this continued investment and positive outlook?
That's the critical question, isn't it? Yeah. And look, they're not just saying they're optimistic. They're pointing to concrete things. Customer forecasts, specifically, indicating renewed growth. They expect customers to start building up inventory again, stock buildup, starting Q4 this year, 2025, and carrying into 2026.
So they're seeing the pipeline rebuild?
Seems like it.
Yeah.
And to reflect this, their full-year sales guidance was narrowed slightly, but still reaffirmed. It's now 3.9 to 4.1 billion SEK. And the margin target also reaffirmed at a healthy 9.5% to 10.5%.
Okay, but why the narrowing on sales then, if they're optimistic?
Good catch. The slight reduction at the top end of that sales guidance, that's primarily due to the stronger Swedish krona currency effect.
Right, FX headwinds.
Exactly. It impacts their reported sales by roughly 100 million SEK for the year. It's not about a fundamental operational slowdown.
Got it. Okay, let's peel back another layer. Operations. Beyond the financials, what about how the company's actually running day to day? Delivery, quality. These are the foundations, right?
Absolutely. This is where the rubber meets the road. And the news here, honestly, it's exceptionally positive. Their delivery performance, back on track, hitting numbers above 95%.
Wow, really?
Yeah, that's similar to levels they saw before the whole component crisis mess back in 2020, 2021.
So a return to normalcy there.
Pretty much. Think of it like a finely tuned machine just hitting all its marks again after navigating some serious turbulence. And crucially, quality remains world-class. They're exceeding even the incredibly demanding requirements of the automotive industry. That tells you a lot about their internal processes.
Okay, that level of performance, that raises a key question, especially for investors. The order backlog, that's been a topic of, well, a lot of discussion, maybe some anxiety in previous quarters. What's the story there now?
Right, the backlog. It actually increased, up 6% compared to Q1.
Oh, interesting. Not year over year, though.
Well, year over year is down slightly, about 1%. But management considers this quarter over quarter increase a more accurate indicator right now.
Why is that?
Because it reflects recent momentum. It shows how customers are viewing them now. And it suggests customers are placing orders closer to delivery times again, reflecting more confidence in the supply chain stability.
Okay, that makes sense. So investors, they've clearly welcomed this, strong performance, steady margin outlook, especially after those choppy quarters. What's the general buy-side chatter? What are they focusing on coming at these results?
Yeah, the main focus seems to be on that anticipated return to growth, specifically in GreenTech and defense. Those are the hot verticals. That, coupled with management's pretty clear confidence about the second half of the year, investors are looking for tangible signs of where that future growth is really going to come from.
Right, let's break down that segment performance then, because that really gives you the color on where the growth is coming from.
Exactly. So GreenTech showed really robust 15% growth.
15%, nice.
And they expect that to continue somewhere in the 15-20% range, which is fantastic, given the global push for sustainability.
Security and defense.
Security and defense grew an impressive 18% year to date. And remember, that's building on like 100% growth last year. Staggering.
Right, that was huge last year.
Yeah. Now, they do say growth isn't perfectly linear quarter to quarter in S&D, but it's expected to continue strong. Think 20% plus year over year into 2026, mostly driven by defense spending, as you'd expect.
And the other segments.
A bit more mixed. Communication was down 7%, large industrial also soft. But both are expected to rebound later this year, Q3, Q4. Easier comparisons help there, plus they're seeing order intake pickup. MedTech remains, well, relatively flat. Steady, but not spectacular.
Okay, geographically, how's that breaking down?
Western Europe is performing pretty well overall, with one notable exception. The UK.
Ah, yes. What happened there?
Big decline, down 34%, but there's a specific reason. One major customer basically zeroed out their sales for the first 3 quarters of the year.
Ouch. Is that business loss?
No, that's the key thing. It's a hiccup. Production for this specific customer is actually expected to restart after Q3.
I see. So it looks bad on paper right now.
Exactly. Looks concerning, but it's a known temporary issue. It has a clear path to resolution.
Okay. And elsewhere.
The rest of the world region is improving, showing an underlying EBIT that's operating profit of 8%. That's driven by recoveries in places like Estonia and China, which were weak in 2024, plus continued growth in Bulgaria.
And they're managing margins there in lower cost regions.
They are. They've strategically adjusted their cost base in those areas to maintain margins, even with competitive price pressure. Shows smart management adapting to the local conditions.
Good. And you mentioned inventory and lead times earlier as operational wins. Anything more specific the CEO shared on those? There's such key metrics in this industry.
Absolutely. Key bellwethers, really.
Everett.
Especially after all the supply chain chaos. So inventory turn rate, basically how fast they sell and replace stock, it's improved to roughly 4 times a year now. Their target is 5x.
Okay, so still room to improve.
Still room, yeah. But getting there.
Yeah.
And hitting that 5x target implies potentially another 100 million SEK in cash flow just from managing inventory better.
Significant.
Very. And crucially, lead times on customer orders. They've harmonized. Back to pre-component crisis levels.
Oh, that's big.
It is. It means orders are coming in much closer to when they're actually needed and delivered. It signifies a return to a much more predictable, efficient operating environment for everyone.
Okay, so maybe one of the most intriguing aspects for future growth, especially with that strong cash pile you mentioned, M&A acquisitions. Are they just talking about it, or are they actually, on the hunt?
Oh, they are very active. very much on the hunt. And importantly, they are expecting to close at least one acquisition this year.
This year. Okay, they missed their target in 2024, right?
They did. But they noted something interesting. Seller valuation expectations have apparently become more realistic now. Sellers are factoring in the tougher 2024 performance, which, helps buyers like Note B.
Makes sense. What kind of prices are they paying historically?
Historically, around 7 times EBIT, that operating profit measure, again, for businesses with flat growth, maybe 9 to 10 times EBIT for growing ones, and potentially higher for targets heavy in defense, given the current positive tailwinds in that sector.
And what are they looking for? Size, location?
Primarily European companies.
Yeah.
And they're looking for sales above, say, 20, 25 million euros. So they're after meaningful deals, things that will actually move the needle, accretive deals.
Got it. And one last thing, the broader macro picture. Tariffs, global trade jitters. That's been a recurring theme. How's that playing out for Note B specifically?
Yeah, management touched on that. They said while there's some, internal movement between their own factories because of tariffs, major shifts by customers are still mostly on hold. Customers are kind of in wait-and-see mode regarding how global trade policies shake out.
So it's creating uncertainty.
Exactly. The biggest impact of all this uncertainty, according to management, is that it's simply delaying the overall market recovery. It's not stopping things, but it is creating this lingering hesitancy.
Okay. All right. This is the deep dive, so it's time for our This Is Not Financial Advice segment. Considering everything we've just discussed, the strong cash, the M&A talk, those defense tailwinds, let's pitch an unconventional, maybe outrageous, but plausible idea for you to chew on.
Okay, let's try this. Given Note B's really robust financial standing, their stated ambition to buy companies, and that clear momentum in defense, imagine this scenario. A long position in Note B, maybe, just maybe, coupled with a strategic short position on a competitor. A peer in the European EMS space that's less acquisitive, maybe struggling a bit, and crucially, lacks that same exposure to high-growth areas like defense.
Interesting. What's the core thesis there?
The thesis is pretty simple, really. Note B uses its cash pile and the improving M&A climate to consolidate the market. Specifically, maybe they acquire a significant defense-heavy asset, something transformational.
And the outcome?
Well, that could lead to a significant re-rating of their valuation multiple. The market suddenly sees them differently, creates a kind of sum of the parts upside that maybe isn't fully priced in right now. It's basically a bet on inorganic growth, buying growth, as the main driver for some serious outperformance down the line.
A bet on the deal making. Okay, intriguing. So to recap our deep dive into Note B's Q2 earnings, strong beat, impressive operational performance, really solid cash position.
Yeah, definitely a clean beat.
They're clearly optimistic about growth returning in the second half, driven by GreenTech and defense.
Right, those are the key engines right now.
And that active M&A strategy could be a really significant catalyst for future value.
Indeed. They are building for the future. You can see it. Significant growth expected from customers, maybe 1 or 2 years out, even if the current market hesitation affects immediate orders. Now, while this deep dive gives you, we hope, substantial insights, just remember, this is all for informational purposes. It is absolutely not financial advice.
Right. We're here to help you understand the dynamics, not tell you what to do with your money.
Exactly.
We hope this deep dive has given you some valuable insights, maybe a few aha moments, helped you feel truly well-informed. And we love hearing from you. So if anything we discussed sparked a question or a new thought, please don't hesitate to reach out. Perhaps the real story for Note B isn't just about this quarter's numbers, good as they were, but about their deliberate positioning in what looks like a consolidating industry. It's a long game, maybe, that might just be hitting its stride now. Thank you for tuning in to The Deep Dive.